Hello, friends. Today, we're diving into a fascinating book that reveals the hidden connection between biology and financial markets, The Hour Between Dog and Wolf by John Coates. This book uncovers how our body's chemistry, particularly hormones like testosterone and cortisol, influences risk-taking, decision-making, and even market crashes. It explores the biological reactions that drive traders during booms and busts, showing how stress, confidence, and even physical fitness impact financial performance. Coates, a former Wall Street trader turned neuroscientist, takes us deep into the world of trading floors, explaining how the highs of winning trigger hormonal surges and how stress can create market-wide panic. From the winner effect to the impact of chronic stress, this book provides a fresh perspective on why markets behave the way they do. Not just because of logic and strategy, but because of human biology. If you're interested in the psychology of trading, behavioral finance, or just want to understand how your body affects your decision-making, this book is a must-read. Don't forget to like, share, and subscribe for more insightful book breakdowns. Now, let's jump into the core ideas of The Hour Between Dog and Wolf. Introduction: The biology of financial risk-taking. Have you ever felt your heart race before making a big decision? Maybe you were about to invest money, take a risky bet, or make a life-changing career move. That rush, that tension, it's not just in your head, it's happening in your body. And if you've ever wondered why financial risk-taking feels so intense, science has an answer. John Coates, a former Wall Street trader turned neuroscientist, spent 12 years watching traders make and lose fortunes. He noticed something strange. Traders didn't just react logically to market shifts, they reacted physically. Their bodies changed. Their emotions changed. Some became overconfident, taking bigger and bigger risks. Others froze in fear, unable to make decisions. It wasn't just psychology, it was biology. In this book, Coates explores a powerful idea. The same biological responses that help us survive life or death situations are also triggered when we take financial risks. Whether it's a high-stakes trade, a poker game, or even a business decision, our body reacts as if we're stepping into a battlefield. But why does this happen? And how does it shape the way we think, act, and even crash under pressure? Let's break it down. The fight-or-flight response in trading. Imagine you're walking in the woods, and suddenly you hear a rustle. You freeze. Is it a harmless animal, or is it a predator? Your body kicks into fight-or-flight mode, a survival mechanism that prepares you to either fight for your life or run as fast as you can. Now, here's the crazy part. The same biological reaction happens when traders take financial risks. When a trader sees an opportunity in the market, their heart rate increases. Blood flows to their muscles. Adrenaline surges. If they win a trade, testosterone spikes, making them feel powerful, almost invincible. They take bigger risks, feeling like they can't lose. But when the market crashes, that's when cortisol, the stress hormone, floods the system. Their body tells them, danger, stop, retreat. They hesitate, become overly cautious, and sometimes make irrational decisions. Coates explains that financial risk-taking is not just about numbers, it's about chemistry. How risk changes the body. Most people think emotions are purely mental, but Coates argues that emotions are deeply physical. When we experience risk, our body changes in ways we don't even realize. 1. Heart rate increases. When faced with risk, our heart starts pumping faster. Traders, athletes, and soldiers all experience this before making a big move. 2. Blood flow shifts. In dangerous situations, blood moves away from the stomach and into the muscles, preparing the body for action. 3. Hormones surge. Testosterone makes us feel aggressive and confident, while cortisol triggers fear and hesitation. These chemicals shape how we make decisions. And here's the thing. These reactions don't just last for a few seconds. They can last for days, weeks, even months. The two key themes of this book. Coates sets the stage for the book by introducing two major themes. 1. How professional traders make and lose money. He doesn't just explain trading strategies. He dives into the emotional roller coaster traders experience and how their body reacts to winning and losing. 2. The physiology behind decision-making. He explores the science of how hormones and brain chemistry impact risk-taking. Why do people become reckless in booms and terrified in crashes? The answers lie in biology. Overconfidence, market cycles, and financial crashes. One of the most fascinating ideas in this book is how hormones shape financial markets. During bull markets, when stocks are rising and everyone is making money, traders feel like kings. Their testosterone levels rise, making them more aggressive. They take bigger and bigger risks, sometimes too big. This is what fuels financial bubbles. Traders, investors, and even everyday people start believing this time is different, that the market will keep going up forever. But it never does. Eventually, reality kicks in. A small event, maybe bad economic news, causes uncertainty, fear spreads, cortisol levels rise, traders start doubting their decisions, they become overly cautious, they hesitate, some even freeze completely, unable to take action. And just like that, the market crashes. Coates argues that these cycles, euphoria, reckless risk-taking, and panic, are not just economic, they are biological. Our bodies drive us into booms and busts. It's not just Wall Street, it's human nature. Now, you might be thinking, this is interesting, but I'm not a trader. How does this apply to me? Here's the truth. Risk-taking is everywhere. An entrepreneur deciding whether to quit their job and start a business. A poker player going all in on a hand. A soldier making a split-second decision in battle. An athlete taking a crucial shot in the final seconds of a game. In all these cases, the same biological forces are at work. The difference? Some people learn how to control their body's reaction to risk, while others let it control them. Coates explains that by understanding the physiology of risk, we can make better decisions, not just in finance, but in life. Why this book matters. This book isn't just about traders. It's about understanding human nature. Why do some people take extreme risks, while others hesitate? Why do markets crash in predictable cycles? How can we control our body's response to risk instead of letting it control us? Coates spent years studying traders, soldiers, and athletes to answer these questions. And what he found is that our decisions are not purely rational. They are deeply biological. Biology of a market bubble: how success can become a dangerous drug. What makes a financial bubble so powerful? Why do smart investors, traders, and business leaders, who should know better, keep getting caught in cycles of overconfidence and reckless risk-taking? John Coates doesn't just explain bubbles in economic terms. He goes deeper into the biology behind why people make irrational decisions when money is flowing. He argues that financial bubbles aren't just market events, they're biological events, driven by chemical changes inside the human body. And here's the scary part. Success itself can act like a drug. Wall Street in the 1990s, a front row seat to market mania. In the 1990s, Coates worked at Goldman Sachs, Merrill Lynch, and Deutsche Bank, some of the biggest names in finance. He saw firsthand how traders and investors reacted to market booms. One story that stuck with him was Cosmo.com, a startup that promised free one-hour delivery in Manhattan. Investors were pouring millions into it. But when the dot-com bubble burst, Cosmo collapsed. The big question was, what on earth were investors thinking? The answer? They weren't thinking rationally at all. Their bodies, specifically their hormones, were driving them into risky, reckless decisions. The science of a bull market. In a rising market, investors become addicted to success. The more their investments rise, the more confident they feel. The market keeps validating their beliefs, reinforcing the idea that they're smart, powerful, and unstoppable. But here's the biological twist. This isn't just an emotional reaction, it's a chemical one. 1. Testosterone, the confidence drug. When traders win consistently, their testosterone levels surge. Testosterone boosts aggression, confidence, and risk-taking, which is useful in competition but dangerous in finance. It makes people feel invincible, leading them to take bigger and bigger risks. 2. Hubris syndrome, the disease of power. Former UK politician David Owen coined the term hubris syndrome, a disorder where powerful individuals develop reckless overconfidence. It happens when someone holds power for too long with no checks or balances. Symptoms include arrogance, ignoring details, dismissing critics, and making disastrous decisions. In financial markets, traders experiencing long winning streaks start to believe they can't lose. And here's where it gets even more dangerous. Winning feels like a drug, because it is. Coates found that traders who enjoy an extended winning streak experience something similar to a narcotic high. They don't just feel confident, they feel wired, almost intoxicated. Their personality starts to change. They stop questioning their own decisions. They ignore risks that they would normally be cautious about. This explains why market bubbles keep forming. People aren't just chasing money, they're chasing the feeling that comes with winning. But as history has shown, bubbles don't last forever, and when the market turns, so does the chemistry inside traders' bodies. The crash, when confidence turns to panic. What happens when the market starts to fall? Just as testosterone drove traders to take bigger risks during the boom, another chemical now takes over. Cortisol, the stress hormone. Cortisol floods the system, triggering anxiety and fear. Traders and investors panic, second-guessing their every move. They freeze, hesitate, or overreact, selling at the worst possible time. This shift in body chemistry is why people who were bold risk takers during a bull market suddenly become paralyzed with fear in a bear market. The same biology that fuels market bubbles also fuels market crashes. Why this matters beyond Wall Street. Now, you might be thinking, okay, but I'm not a stock trader. How does this apply to me? The truth is, this hormonal cycle of success, overconfidence, and crash happens everywhere. Entrepreneurs who experience early success can become reckless, overestimating their abilities. Poker players who go on a winning streak often start making bolder, riskier bets. Athletes who keep winning can become too aggressive, ignoring strategy. Understanding this biological cycle is key to avoiding major mistakes in any high-risk environment. Lessons from the biology of a market bubble. 1. Success can be a drug. Winning triggers testosterone, making us overconfident. Too much of it can lead to reckless decisions. 2. Power without limits creates hubris syndrome. Leaders who experience unchecked success for too long start ignoring reality. They stop listening to others, which can lead to disastrous failures. 3. Market crashes aren't just economic, they're biological. When things go wrong, cortisol floods the system, creating panic. The same traders who were aggressive in a bull market become hesitant in a bear market. The big takeaway: controlling your biology in high-stakes situations. Coates argues that if we understand how our body reacts to risk, we can control it. Recognize the warning signs. If you start feeling invincible after a winning streak, take a step back. Overconfidence is dangerous. Balance aggression with caution. Confidence is good, but unchecked risk-taking can lead to disaster. Stay grounded. Surround yourself with people who challenge you, so you don't fall into the trap of hubris syndrome. The hidden biology of risk: why some people resist market frenzy. When financial bubbles form, we often assume it's all about greed, fear, and market speculation. But John Coates takes a different approach. He looks at the biology behind why some people get caught up in risky behaviors while others stay immune. One fascinating observation he makes: women were relatively immune to the frenzy surrounding high-tech and internet stocks. Why didn't women fall for the market hype? During the dot-com bubble, male traders rushed in, fueled by overconfidence and the thrill of the rising market. But Coates noticed that women weren't as easily swept up in the mania. Why? The answer may lie in biology. Men, especially young men, experience higher testosterone levels, which drive risk-taking and aggression. Women have lower testosterone levels, making them less prone to overconfidence. This difference in hormonal chemistry may explain why women weren't making the same reckless bets as men. This is a crucial insight, not just for trading, but for understanding how risk-taking works in general. Is there a bull market molecule? Coates suggests that traders' risk-taking during bubbles might not just be psychological, it could be pathological. Could there be a specific hormone driving financial mania? A bull market molecule that makes people overconfident, reckless, and blind to danger? Scientists are still searching for this answer, but one thing is clear: hormones don't directly control behavior, but they influence it, just like lobbyists influence politicians. Hormones don't force us to take risks, but they pressure us, making certain decisions seem more appealing. This means that understanding our body's chemical reactions can help us make better financial and life decisions. The hypothalamus, the body's master controller. To understand how hormones affect behavior, we need to look at the hypothalamus, a small but powerful part of the brain. The hypothalamus acts like a command center, ensuring that the body and brain stay in sync. Here's how it works. 1. The hypothalamus triggers glands to produce hormones. 2. These hormones enter the bloodstream and affect different body tissues. 3. Once the hormones have done their job, they return to the brain, signaling the hypothalamus to stop production. This system is known as a feedback loop, a biological process that keeps things balanced. But what happens when this loop is disrupted? That's where things get interesting. Bruce McEwen's discovery: the brain has more hormone receptors than we thought. For years, scientists believed that once hormones completed their feedback loop, their job was done. But neuroscientist Bruce McEwen discovered something surprising. Hormones don't just return to the hypothalamus, they also interact with other receptors in the brain. This means they can directly influence our thoughts, emotions, and decision-making. And here's the key insight. When steroid hormones like testosterone or cortisol interact with these other receptors, they can change how we think and behave. How this affects risk-taking. Let's put this all together. 1. During a bull market, rising stock prices trigger testosterone surges in traders. This increases confidence, aggression, and risk-taking. The feedback loop reinforces this behavior, making traders take bigger and bigger risks. 2. During a market crash, falling prices cause cortisol levels to spike. This creates stress, fear, and hesitation. Traders suddenly become paralyzed, unable to make rational decisions. So what does this mean for investors, business leaders, and anyone dealing with high-risk environments? The takeaways: how to avoid falling into a biochemical trap. 1. Understand that risk-taking isn't purely logical, it's biological. If you feel unstoppable during a winning streak, recognize that it may not be rational. It could just be testosterone talking. 2. Be aware of the feedback loop. The same chemicals that fuel confidence can also lead to recklessness. Knowing when to step back and check your emotions is key to avoiding financial disasters. 3. Learn from those who resist market frenzy. Women's lower testosterone levels may help them avoid reckless risk-taking. Long-term investors who focus on fundamentals don't get caught up in hype. The winner effect: how success can turn into overconfidence. Have you ever noticed how winning a few times in a row makes you feel invincible? Like you can't lose? That's not just in your head, it's a biological reaction. John Coates explains this phenomenon with something called the winner effect, a cycle where success literally rewires your brain and body, making you more aggressive, confident, and willing to take bigger risks. At first, this sounds like a great thing, but the same process that fuels winning streaks can also lead to reckless decision-making and financial disasters. Let's break it down step by step. Step 1. The anticipation of competition boosts testosterone. Before any high-stakes challenge, whether it's a trading session, a sports match, or a business deal, testosterone levels rise. This happens in both animals and humans. When two animals prepare to fight, their bodies flood with testosterone. The same thing happens before a trader makes a risky bet or an entrepreneur takes a bold business move. Testosterone gives a confidence boost, increases focus, and sharpens decision-making. In small amounts, this is a great thing. It helps people stay sharp and compete at a high level. But here's where things get tricky. Step 2. Success triggers even more testosterone, creating a confidence loop. When someone wins a competition, their body produces even more testosterone. This extra boost of testosterone makes them feel even more powerful, confident, and risk-seeking. In financial markets, this means a trader on a hot winning streak starts making bolder and riskier bets. In sports, this means an athlete pushes harder, believing they are unbeatable. At this stage, the winner effect is in full force. The person feels unstoppable. And for a while, this confidence can actually lead to even more victories. But here's the dangerous part. Step 3. The spiral of victory turns into overconfidence and recklessness. The more a person wins, the more testosterone keeps rising. And eventually, they cross the line from confidence to arrogance. They start believing they can't lose. They ignore risks they would have been cautious about before. Their decision-making becomes overly aggressive and reckless. This is exactly what happens during financial bubbles. Traders on long winning streaks start making insanely risky bets because they feel invincible. And then, reality hits. Markets crash, reckless traders lose everything, and the same testosterone that once fueled their success now disappears. What happens when the winning streak ends? Once a person loses after a long winning streak, something dramatic happens. Testosterone drops. Confidence plummets, stress levels rise. This is where cortisol, the stress hormone, kicks in. Instead of feeling powerful, traders become paralyzed by fear. They hesitate, second-guess themselves, and fail to take action, even when good opportunities appear. And just like the winner effect creates an upward spiral, this loser effect creates a downward spiral of fear and inaction. This cycle happens over and over again in financial markets, sports, business, and even personal life. Real-life examples of the winner effect in action. Example 1. The stock market boom and bust cycles. During bull markets, successful traders get flooded with testosterone. They take bigger risks, assuming the market will keep going up. As long as the market validates their confidence, they keep winning. But when the crash comes, they are too deep in risk and lose everything. Example 2. CEO overconfidence. Business leaders who experience early success often become overconfident. They start making risky acquisitions, ignoring warnings, and taking reckless bets. Many successful CEOs crash and burn because they don't recognize when they've crossed the line into arrogance. Example 3. The rise and fall of athletes. Many young athletes dominate early in their careers due to talent and confidence. But after too many easy wins, they start underestimating opponents. They stop training as hard, take unnecessary risks, and eventually suffer major defeats. How to avoid falling into the winner effect trap? 1. Stay aware of your own confidence levels. Winning feels good, but ask yourself, am I still thinking clearly? Confidence is good, but unchecked arrogance leads to bad decisions. 2. Control risk even when winning. If you're on a winning streak, don't assume it will last forever. Always have a risk management plan in place. 3. Surround yourself with people who challenge you. Overconfident leaders often push away critics. Stay open to constructive criticism. It keeps arrogance in check. 4. Regulate your emotions. If you feel unstoppable, take a step back and reassess. If you feel fearful and paralyzed, take small actions to regain momentum. The myth of rationality in financial markets. For decades, economists have told us that markets are rational. The idea is simple. Irrational traders will eventually go bankrupt. Only rational investors survive, ensuring markets remain efficient. Sounds logical, right? But John Coates argues that this belief is dangerously flawed. Why economists believe markets should be rational? In traditional economic models, people are assumed to make logical, well-calculated decisions, especially when it comes to money. If someone acts irrationally, taking too many risks, making bad trades, they should eventually lose their money. In theory, this should leave only the most rational players in the market. But real-world markets don't work this way. The reality. Investors are not always rational. Social scientists have proved over and over again that investors make irrational decisions, even when money is on the line. They follow the crowd instead of thinking for themselves. They panic and sell at the worst possible moment. They hold on to losing trades too long, hoping for a comeback. They become overconfident during booms and overly fearful during crashes. These emotional and biological responses create market bubbles and crashes. The big problem: economic models ignore biology. Traditional economic theories focus only on the mind. They assume trading is purely a mental exercise, a game of logic and calculation. They ignore the connection between the mind and the body. But Coates argues that risk-taking is deeply tied to our biology. Our bodies react to markets the same way they react to physical threats. And here's where things get really messy. We have the worst of both worlds. Coates explains that financial markets are built in a way that makes crashes even worse. We have two major problems. 1. Unstable biology. Our hormones push us to take bigger risks when things are going well. When the market is rising, traders feel unstoppable, and they double down on risky bets. But when the market crashes, stress hormones flood the body, leading to fear, hesitation, and panic selling. 2. Risk management that makes crashes worse. Financial institutions increase risk limits during bubbles, letting traders take even bigger bets. But when the market crashes, they suddenly cut off risk-taking, forcing traders to sell at a loss. This creates a self-reinforcing cycle. In good times, more risk equals bigger bets equals even higher prices, more confidence, even riskier bets. In bad times, losses, risk limits reduced, forced selling, prices fall further, more panic. Why this matters? Economic models assume markets are rational, but biology proves otherwise. Traders aren't just making logical decisions, they're reacting to hormones and emotions. The way financial systems are designed amplifies booms and busts, making markets even more unstable. Thinking with your body. When we think of intelligence, we usually imagine mental abilities, logic, memory, reasoning. But what if the brain was never meant to think in isolation? John Coates argues that the brain and body evolved together, and that movement, not thought, might be the real reason we have such powerful brains. The C-squared experiment, why move if you don't have to? Let's start with a strange creature, the sea squirt. This little marine animal swims freely as a larva with a tiny brain. But once it finds a place to attach itself, like a rock or coral, something shocking happens. It digests its own brain. Why? Because it no longer needs to move. The lesson? Brains exist for movement. If an organism doesn't need to move, it doesn't need a brain. The brain evolved not just for thinking, but for controlling movement. And for humans, movement is more complex than we realize. Human movement is more complex than quantum mechanics. Coates makes a bold claim. Understanding human movement is harder than understanding quantum mechanics or even the human genome. That might sound crazy, but think about it. Humans are the only species that can learn new, complex movements like playing instruments, flying planes, or gymnastics. Perform delicate movements like a surgeon's precise incisions. Adapt movements in real time based on the environment. This level of complexity required bigger, more advanced brains. The brain's control system, how we move and think. To handle this unbelievable complexity, our brain developed some incredible systems. 1. The neocortex, the thinking and planning center. This is the part of the brain that grew the most in human evolution. It allows us to make choices, plan ahead, and strategize movements. 2. The corticospinal tract, the brain-body superhighway. A powerful network of nerves that connects the brain to muscles. It's why humans can develop highly refined motor skills that other animals simply can't. 3. The cerebellum, the brain's high-speed memory bank. This part of the brain stores muscle memory. Think of it like extra RAM in a computer. It allows us to perform movements automatically, like riding a bike or typing on a keyboard. These systems work together to allow humans to move, adapt, and learn at an unmatched level. Your brain is always working, even when you're not thinking. We tend to believe our brains are active only when we're thinking. But in reality, our brain is always monitoring and controlling our body. At any given moment, your brain is regulating blood sugar levels, breathing rate, heart rate, body temperature, blinking, blood pressure. And it does all of this without you even noticing. This ability is what makes mammals different from reptiles. Mammals and the power of internal awareness. Reptiles, like lizards and snakes, don't have the same level of internal control as mammals. Their brain functions are simpler and require less energy. But mammals develop more advanced neural circuits to manage body functions better. This extra control comes at a cost. It requires more brain power and more energy. But it also gives mammals, especially humans, an incredible ability. Interoception, the brain's hidden superpower. Interoception is the brain's ability to sense what's happening inside the body. Your brain has special receptors that detect things like internal temperature, chemical changes, and nutrient levels. Most of this happens unconsciously, but some signals, like hunger or thirst, we actually feel. This deep internal awareness helps the brain make better decisions based on the body's needs. And that leads us to one of the most fascinating discoveries in neuroscience. Gut feelings, emotions, and rationality are all connected. Neuroscientist Bud from the University of Arizona made an incredible discovery. Emotions, gut feelings, and rational thought are all part of the same system. These abilities didn't evolve separately. They evolved together to help the brain regulate the body. This means your emotions are not separate from logic. When you feel nervous before a big decision, that's your brain reading signals from your body. When you get a gut feeling that something is wrong, it's not just instinct, it's real biological feedback. This completely challenges the traditional idea that rational thinking and emotions are separate. What this means for traders and investors. Now let's bring this back to the financial world. If traders and investors ignore their body's signals, they might miss out on crucial information. If their heart rate spikes before making a trade, their body might be detecting hidden risks. If they feel overconfident during a bull market, their brain could be misinterpreting hormonal surges. If they experience extreme stress during a market crash, their biological system might push them to panic sell. Coates argues that financial professionals should pay closer attention to their internal signals. The speed of thought. Imagine a trader in the stock market, staring at the screen as prices change in milliseconds. How does the brain keep up with something so fast? John Coates reveals something shocking. Our conscious brain is too slow to interpret and respond to the world around us. So if conscious thinking is too slow, how do we react so quickly in fast-paced environments like trading, sports, or combat? Your brain doesn't just react, it predicts. If we relied on conscious thought to respond to everything, we'd constantly be too late. A pitcher throws a baseball at 95 miles per hour. A trader sees a stock plummeting in real time. A sprinter hears the starting gun. In all of these cases, the conscious mind is too slow to react. That's why the brain doesn't wait for information. It anticipates what will happen before it happens. Speed versus accuracy, the brain's processing dilemma. If we rely too much on speed, we might act too soon and make mistakes. If we rely too much on accuracy, we might be too slow and miss opportunities. The brain constantly balances this trade-off by using two different processing systems. Light versus sound, how the brain handles different sensory speeds. You'd think that because light travels faster than sound, the brain should always prioritize vision. But that's not the case. 1. Long-distance observations, vision over sound. At long distances, light travels faster than sound, so we see things before we hear them. That's why we see lightning first and hear thunder later. The brain has adapted to this, prioritizing sight over sound when objects are far away. 2. Short-distance observations, sound over vision. At short distances, the brain actually processes sound faster than sight. That's why, in a conversation, we react to words faster than facial expressions. This is why athletes, musicians, and traders often rely on auditory cues when responding to fast situations. The horizon of simultaneity, where sight and sound become equal. John Coates introduces a fascinating concept. At around 10 to 15 meters from us, the brain processes sound and sight equally. At this distance, neither sense dominates. Our reactions are balanced. But when things happen closer or farther than this, the brain adjusts its priority. This is why boxers and fighters listen for their opponent's breathing instead of watching them. Traders react to market sounds faster than price movements. Drivers rely on engine sounds to detect acceleration before they feel it. Why conscious thought slows us down. When fast reactions are required, consciousness is cut out. The brain shifts into reflex mode and uses pre-attentive processing. This is how you catch a falling glass before thinking about it. It's also why experienced traders react to patterns instinctively. The more complex the brain becomes, the more neurons it has to process information. This creates longer neural pathways, making conscious responses slower. That's why learning a new skill feels slow. Experienced professionals react instinctively. As we practice, the brain pushes learned skills down to lower brain levels, making them automatic and faster. How learning becomes automatic. Think about playing Tetris. At first, you consciously think about where to place each block. Over time, the game speeds up and you stop thinking. You just react. This happens because the brain shifts control from the slower conscious mind to faster subconscious systems. The same applies to driving. At first, you think about every movement. Later, you just do it. Trading. Beginners overanalyze. Experienced traders act instinctively. Sports. A new boxer thinks before throwing punches. A pro reacts without thinking. Consciousness is just a bystander. Coates suggests something shocking. Consciousness doesn't control most of what we do. Instead, consciousness observes our automatic responses, interprets our actions after we've already done them. It's like a sports commentator watching the game and explaining what's happening, but not actually playing. Why do we have consciousness? If consciousness is so slow, why does it exist? One possible reason: it acts as an override mechanism. Most of the time, we act on instinct and let the subconscious brain handle decisions. But in critical situations, consciousness steps in and overrides automatic responses. For example, a trader sees a rapid stock rise. His instinct says buy, but his conscious brain stops him, knowing it's a bubble. A fighter sees an opening. His instinct says attack, but his conscious brain holds back, sensing a trap. A driver on ice feels the car slide. His instinct says slam the brakes, but his conscious brain overrides it, knowing that will cause a skid. Consciousness isn't fast, but it prevents catastrophic mistakes. How traders can use this knowledge. Traders live in a world where milliseconds matter. Understanding how the brain processes information can help them react better to market changes. Know when to trust your instincts. If you've trained enough, subconscious reactions can be more accurate than conscious ones. Recognize when emotions take over. Overconfidence or fear can hijack decision-making. Use conscious thought as a safety check. When the market is chaotic, step back and assess before acting. Gut feelings, how our instincts guide and misguide us. Have you ever had a strong gut feeling about something? An urge to make a trade? A feeling that someone is lying? Or a sense that danger is near? John Coates explores why gut feelings exist, how they work, and when we should trust them. What are gut feelings? A gut feeling isn't just a vague intuition. It's a strong conviction accompanied by physical symptoms. You feel tightness in your chest. Your stomach twists. Your heart races. These reactions happen before we consciously realize why we feel this way. Thinking with your body, how the brain reads physical signals. Our brain doesn't just process thoughts, it processes bodily sensations too. This is called interoception, the brain's ability to sense what's happening inside the body. If your heart rate spikes suddenly, your brain interprets this as danger. If your breathing slows and muscles relax, your brain interprets this as safety. These bodily signals create what we call gut feelings. The two modes of thinking, automatic versus controlled. The brain operates in two ways. 1. Automatic thinking, fast, intuitive, emotional. 2. Controlled thinking, slow, logical, deliberate. Much of our daily thinking happens automatically. You don't have to think about walking, driving, or reading facial expressions. Your gut feeling is often just your brain recognizing a pattern before you consciously realize it. Are gut feelings always right? Not necessarily. Sometimes gut feelings save lives, like a firefighter who senses a building will collapse and gets his team out just in time. But sometimes gut feelings lead us astray, like a trader who feels a stock will go up, but it crashes. So how do we know when to trust gut feelings? Kahneman and Klein. When is intuition reliable? Daniel Kahneman and Gary Klein studied intuition deeply. Their conclusion? Intuition is just pattern recognition. For intuition to work reliably, two conditions must be met. 1. The environment must be regular enough to create repeating patterns. 2. The person must have enough experience to recognize these patterns and get quick feedback. Did I get it right or wrong? If these conditions aren't met, intuition is unreliable. Can traders trust their intuition? Now comes the big question. Do financial markets have stable patterns? The efficient market hypothesis, EMH, says no. Markets move based on news, and news is unpredictable. But economist Robert Shiller argues that trading skill does exist. Traders improve over time. The Sharpe ratio, profit versus risk of traders, increases with experience. Some traders consistently make profits and experience less volatility. This suggests that markets do have some stable patterns, even if they're hard to spot. So can traders trust their intuition? The answer is yes, but only after years of experience. Gut feelings versus rational thought, which one wins? Some people say intuition is better than rational thinking. Others say rational thinking is more reliable. But John Coates calls this a red herring. We use both. Intuition helps us narrow options quickly. Rational thought helps us analyze and decide. Together, they form a powerful decision-making system. How the body influences decision-making. Our gut feelings and emotions aren't just mental, they're deeply connected to the body. Neuroscientists Antonio Damasio and Antoine Bechara studied patients with brain damage in areas that link emotions to decision-making. These patients had perfectly normal intelligence, no problem analyzing data, but they made terrible decisions. Why? Because they couldn't feel gut feelings anymore. They would overanalyze every choice but never reach a decision. This shows that gut feelings play a critical role in decision-making. How traders can use this knowledge. For traders, the key takeaway is, gut feelings are useful, but only when trained. Experience creates pattern recognition, which leads to accurate intuition. New traders should rely more on rational thinking and analysis. Experienced traders can use intuition as a guide, but should still verify with logic. The science of emotion. How our feelings shape decisions. Ever wonder why emotions feel so powerful? Why does fear make our heart race, or excitement make our stomach flutter? John Coates explores the deep connection between emotions, the body, and decision-making, especially in the world of trading. Are feelings just along for the ride? In the late 1800s, psychologist William James made a bold claim. Feelings don't cause emotions. They are just observers tagging along after an event. This means we don't cry because we feel sad. We feel sad because we cry. Sounds backward, right? But modern science supports this idea. Why does the brain send messages to the body instead of keeping them inside? Imagine you're about to be attacked. Your brain has two choices. 1, think about it, process the danger, and then decide to run. 2, trigger a full body reaction instantly, heart pounding, muscles tensed, so you can react before thinking. The brain chooses the second option because speed is everything. This explains why emotions feel so physical. Fear speeds up your heartbeat and tenses your muscles, so you can run. Anger floods your body with energy, so you can fight. Excitement activates your nerves, so you stay alert. Emotions are reflexes, not just feelings. John Coates argues that emotions aren't just mental experiences, they're physical reflexes. They help us move faster. They prepare us for action. This is why traders who ignore emotions make worse decisions. They think trading is purely logical, but in reality, their body is sending them signals they don't understand. Facial expressions can change how you feel. In a fascinating experiment, psychologists Robert Levinson and Paul Ekman found that when people smiled, they started feeling happier. When they frowned, they felt sadder. This supports William James's theory. The body creates emotions before the mind even realizes it. So, if you want to feel more confident in trading, smiling and standing tall might actually help your body believe it. Every emotion has a unique physical signature. By now, it's clear that emotions aren't just in our head. They're deeply connected to our body. Each emotion comes with a distinct pattern of nervous system and hormonal activation. Fear equals adrenaline spikes, heart races, body on high alert. Confidence, relaxed muscles, steady heartbeat, deep breathing. Excitement, dopamine surge, sharp focus, high energy. These physical states shape how traders make decisions. The conscious brain has surprisingly little control. We like to believe we are in control of our decisions, but science says otherwise. John Coates explains that. Most decisions happen below the level of conscious awareness. We often act first and rationalize later. This is why experienced traders trust their instincts, because their subconscious brain has been trained through years of market exposure. Can we predict trading success by measuring physiology? What if we could measure a trader's emotions in real time to predict their success? John Coates suggests that tracking physical signs like heart rate variability, cortisol and testosterone levels, skin conductance, sweat response to stress, power details might help determine who can handle high-risk trading and who can't. This concept is already being tested. Some hedge funds monitor traders' biometrics to assess their decision-making under stress. How traders can use this knowledge. 1. Understand that emotions are physical, not just mental. 2. Train your body to send the right signals. Good posture, controlled breathing. 3. Recognize when emotions are guiding your decisions, both positively and negatively. 4. Use physiological monitoring, like heart rate tracking, to assess your mental state. The thrill of the search. Why we chase risk, information, and uncertainty. Why do traders love the thrill of the market? Why do people take risks even when they know it's dangerous? And why are we addicted to new information? John Coates dives into the brain's deep connection with risk, uncertainty, and dopamine, explaining why some traders thrive under pressure while others spiral into addiction. Mild stress and risk are good for us, but only in balance. Think about a time when you felt truly alive, maybe during a close game, a tough challenge, or a risky decision that paid off. Science shows that mild amounts of risk, fear, and stress are actually good for us, but we need time to recover afterward. Too little stress, boredom. Too much stress is burnout. The sweet spot is somewhere in between. This balance is what traders experience when they take calculated risks. A rush of excitement, but not complete chaos. Why uncertainty information? Legendary mathematician Claude Shannon discovered a surprising link. The amount of information in a signal is proportional to its uncertainty. In simple terms, if something is predictable, it's not real information. If something surprises us, our brain considers it valuable. This is why our senses tune out the expected and hone in on the unexpected, because new information helps us survive. Example, you don't notice you're breathing, but you instantly notice a sudden noise behind you. This survival instinct is deeply wired into us. Why we ignore the obvious. Ever stare at one spot for a long time and notice things fading away? This is called Troxler fading, your brain's way of ignoring unchanging information. Traders experience something similar. They don't focus on steady, expected market trends. They obsess over unexpected spikes, crashes, and anomalies. The brain filters out the ordinary and locks onto the extraordinary because new patterns hold power. The brain's chemical response to real information. When we receive new, meaningful information, our brain releases noradrenaline, a chemical that boosts neuron activity, speeds up thinking and reaction time. This is why experienced traders react quickly to breaking news. They don't just process information, they feel it in their nervous system. How the brain separates important versus unimportant information. The brain doesn't just react to every bit of data. That would be exhausting. Instead, it searches memory for patterns, running a cycle of 1. Recognition. Have I seen this before? 2. Assessment. Is it important? 3. Alarm. Do I need to react? This prevents us from being fooled by irrelevant information, a key skill for successful traders. The dopamine connection. Why we're addicted to the search. Now here's where things get really interesting. The chemical that drives our addiction to new information is dopamine, the same chemical behind gambling addictions, social media scrolling, the rush of a winning trade. Dopamine spikes when we expect a reward, not when we actually get it. This explains why. Traders feel an intense rush just before making a trade. People check their phones obsessively, even when there's nothing new. The trap. when dopamine hijacks risk-taking. Dopamine isn't just about reward, it's about the thrill of uncertainty. This can lead to a dangerous cycle. 1. A trader wins a big trade, dopamine surges. 2. They start craving that feeling again. 3. They take bigger risks to get the same rush. 4. Risk tolerance rises, but discipline drops. This is how addiction to risk develops. Traders start gambling instead of strategizing. Animals prefer to work for food. Why don't we? Scientists found something strange. Animals actually prefer to work for food rather than receive it passively. This is because dopamine rewards effort, but today, people prefer passive consumption, watching Netflix instead of creating, scrolling instead of learning. Why? Coates suggests this might be a side effect of modern overstimulation. Our brains are overwhelmed, so we take the easy route. J.M. Keynes, optimism drives action. Legendary economist John Maynard Keynes had a deep insight into human nature. A large proportion of our positive activities depend on spontaneous optimism rather than mathematical expectation. Translation? We don't act purely on logic. We take risks because we feel hopeful, even if the math says otherwise. This explains why markets rise beyond fundamentals. Traders are driven by optimism, dopamine, and the thrill of uncertainty. What this means for traders. Understand that dopamine drives risk-taking. Don't let dopamine trick you into reckless decisions. Recognize when you're trading for strategy versus trading for a thrill. Take breaks to reset your brain. Constant stimulation leads to burnout. The fuel of exuberance. How testosterone and dopamine drive market bubbles. Why do traders go all in during market booms? What makes some investors unstoppable winners while others crash and burn? John Coates explores how hormones like dopamine and testosterone shape financial decisions, showing why markets bubble, why some traders keep winning, and why too much success can lead to disaster. How market booms trigger a chemical high. Think about a time when everything was going your way, when success felt effortless and confidence was through the roof. Now, imagine that feeling supercharged by biology. During financial booms, traders experience a surge in dopamine and testosterone, chemicals that make them feel invincible. Here's how it works. 1. Bubbles create massive profits. 2. Big profits trigger a dopamine rush. 3. Dopamine fuels the desire for even bigger wins. 4. Testosterone rises, amplifying the effect of dopamine. 5. Traders take bigger risks, feeling unstoppable. This is why market booms become self-reinforcing. As profits rise, so does risk-taking, leading to even bigger bets and even bigger bubbles. Testosterone and dopamine, a dangerous combo. Scientists have found that testosterone amplifies dopamine's effects, which suggests that steroids can be addictive because they supercharge the brain's reward system. Testosterone, however, works on a different timeline than adrenaline or dopamine. Dopamine equals instant excitement, like winning a bet. Adrenaline, rapid response, like dodging a car. Testosterone, long-term dominance, building confidence over time. This means testosterone-driven risk-taking isn't just a one-time event. It grows over weeks, months, or even years. The winner effect. Why winning leads to more wins. Ever notice how some people keep winning while others struggle? There's a biological reason for that. It's called the winner effect. Winning in one competition increases the chances of winning in future competitions. How does this happen? 1. Winning boosts testosterone. 2. Higher testosterone improves confidence, aggression, and risk-taking. 3. This gives winners an edge in the next competition. This explains why successful traders, athletes, and business leaders often stay on winning streaks. Example. Tennis players with a strong winning record tend to win even more because their testosterone stays elevated, keeping them sharp and competitive. Testosterone in competitive markets, a long-term effect. Testosterone doesn't just affect individuals, it shapes entire societies. In more competitive environments, like free market economies, testosterone levels tend to be higher across the population. This testosterone-fueled competitive drive can last for years, creating a culture of aggression, innovation, and risk-taking. This means financial markets aren't just shaped by numbers, they're shaped by human biology. Testosterone and high-frequency trading, the data. Researchers measured testosterone levels in traders and found two key patterns. One, on days when traders made above average profits, their testosterone levels were significantly higher. Two, if a trader's testosterone was high in the morning, they tended to make even larger profits in the afternoon. This suggests that testosterone isn't just a response to success, it actually fuels more success. And yet, there's a dark side. The 2D/4D ratio, testosterone exposure, starts before birth. Here's a weird but fascinating fact. The length of your ring finger compared to your index finger can reveal how much testosterone you were exposed to in the womb. This is called the 2D/4D ratio. A longer ring finger, relative to the index finger, equals higher prenatal testosterone exposure. This is linked to higher risk-taking and financial success later in life. In other words, some traders may be biologically wired to take risks from birth. Testosterone, higher risk, higher rewards, but no smarter trades. While testosterone increases profits, there's an important catch. It doesn't improve a trader's Sharpe ratio. For non-traders, the Sharpe ratio measures risk-adjusted returns. What does this mean? Testosterone leads to higher profits, but not necessarily better decision-making. Traders with high testosterone don't make smarter trades, they just take bigger risks. This is why testosterone-fueled traders can experience huge gains, but also massive crashes. The dark side, when testosterone goes too far. At first, rising testosterone gives traders an edge. They feel confident, take smart risks, and win big. But over time, too much testosterone leads to reckless behavior. Traders start making bigger, riskier bets. They become overconfident, ignoring warning signs. They take on more leverage, believing they can't lose. This is how market booms turn into bubbles. And there's another downside. Testosterone wears down the body faster, leading to higher stress levels, increased risk of burnout, shorter lifespan in high testosterone individuals. Testosterone doesn't start market booms, but it fuels bubbles. One last critical insight. Testosterone doesn't create bull markets, it amplifies them. Markets usually take off due to a real breakthrough, like a new technology, industry shift, or financial innovation. But once the rally begins, testosterone kicks in, making traders more aggressive. This turns a rational uptrend into an unsustainable bubble. What this means for traders. Recognize when you're trading on confidence versus trading on skill. Watch for signs of overconfidence. Testosterone can trick you into reckless risk-taking. Understand that market bubbles aren't just financial, they're biological. Don't assume past success guarantees future success. Winning streaks can create blind spots. The stress response on Wall Street. How seasonal changes affect testosterone and market performance. Testosterone levels in animals change throughout the year, and humans experience the same fluctuations. Research shows that testosterone peaks in the spring and drops in the autumn, which can have a significant impact on financial markets. This seasonal cycle may explain why stock markets tend to perform better on sunny days and worse during the winter months, when many investors experience seasonal affective disorder. With reduced daylight hours in autumn and winter, mood levels drop, risk tolerance decreases, and overall market performance tends to decline. The stress response, a biological emergency mode. Stress is the body's way of switching from normal functioning to an emergency state. On Wall Street, traders face extreme pressure and uncertainty, triggering the same physiological reactions that helped humans survive dangerous environments. This stress response unfolds in distinct stages. 1. Fight or flight activation. The amygdala, the brain's fear center, detects danger and sends out rapid electrical signals. These signals travel through the brainstem to key organs like the heart and lungs, increasing heart rate, breathing, and blood pressure, all to prepare for immediate action. This phase burns a significant amount of energy, sustained by a rush of adrenaline. 2. Transition to long-term stress mode. If the crisis continues beyond the initial fight or flight response, the adrenal glands start producing cortisol, the body's primary long-term stress hormone. Cortisol helps with survival, but it comes with trade-offs. Blocks testosterone and insulin, shifting energy away from normal metabolic functions. breaks down fat and muscle into glucose, ensuring a steady energy supply, suppresses the testosterone in men and estrogen in women, reducing overall vitality. Acts as an anti-inflammatory, with endorphins kicking in to dull pain and sustain effort. 3 major triggers of stress in traders. Stress responses in the financial world are fueled by 3 core elements. 1. Novelty. Unexpected market events create uncertainty, triggering stress. 2. Uncertainty. Market volatility and price swings directly increase cortisol levels. 3. Uncontrollability. When traders feel powerless over outcomes, their stress escalates, affecting decision-making, the power of perceived control. One of the most fascinating aspects of stress management is the illusion of control. Animal studies show that creatures exposed to electric shocks experience less stress if they can press a lever to reduce the intensity, even if the lever does nothing. Traders who believe they have control over the market, even if it's an illusion, experience lower cortisol levels. This mental buffer helps them function more effectively under extreme pressure. How high cortisol levels affect market behavior. When stress rises, traders experience dramatic cognitive and behavioral shifts. 1. Impaired focus and increased anxiety. Under intense stress, people scan their environment without knowing what to focus on. This can lead to overtrading, erratic decision-making, and avoiding risks unnecessarily. Cognitive performance under stress. Moderate cortisol levels. Enhance focus, memory, and reaction speed. Too much cortisol, however, cripples decision-making, causing emotional instability, excessive fear, and risk aversion. Chronic stress acts like slow poison, damaging cardiovascular health, weakening the immune system, and impairing cognitive function. 3. Long-term brain damage. Prolonged high cortisol levels shrink certain brain regions, affecting memory, emotional regulation, and decision-making ability. In extreme cases, chronic stress can kill brain cells and permanently alter brain structure. Pattern recognition under stress, seeing what isn't there. Under extreme stress, humans tend to see patterns where none exist, traders misinterpreting random market fluctuations as clear trends. Soldiers in World War I firing at imagined enemies due to prolonged stress exposure. Investors falling into confirmation bias, only noticing data that supports their pre-existing beliefs. This stress-induced pattern recognition leads to overconfidence, impulsive trading, and financial losses. CRH and the fear of the unknown. When stress is prolonged, the body produces corticotropin-releasing hormone, CRH. CRH creates a state of anticipatory angst, a constant feeling of unease about the future. Traders with high CRH levels become excessively cautious, hesitating even on logical, well-calculated trades. This results in missed opportunities, stagnation, and fear-driven decision-making. The psychological trap of learned helplessness. One of the most damaging long-term effects of chronic stress is learned helplessness. When traders experience repeated losses beyond their control, they start believing their actions don't matter. This mindset leads to passivity, lack of confidence, and an inability to bounce back from setbacks. Even highly skilled traders can fall into this mental trap, withdrawing from the market entirely. Why the modern stress response is broken. Our stress response evolved for physical threats, like hunting or escaping danger. But today's stress is psychological and social, financial worries, career pressure, or status concerns. The body, however, reacts as if it's life or death, causing a disconnect between ancient survival instincts and modern realities. Chronic stress is unnatural. The human body wasn't designed for constant uncertainty. Wall Street traders experience daily cortisol spikes, leading to burnout, health issues, and financial instability. Real-world consequences of chronic stress. 1. Physical breakdown. Increased risk of heart disease, immune suppression, and accelerated aging. 2. Emotional instability. Higher anxiety, depression, and impulsive decision-making. 3. Financial self-sabotage. Overtrading, panic selling, and poor risk assessment. How to mitigate stress in trading. Establish routines to reduce uncertainty. Structured trading strategies help. Focus on what can be controlled. Risk management and position sizing are key. Use mindfulness techniques. Meditation and breathing exercises lower cortisol. Limit exposure to financial news. Too much market fear amplifies stress. Prioritize sleep and exercise. Physical health strengthens stress resilience. Toughness is a psychological and physiological trait that determines how we handle stress, challenges, and adversity. It's influenced by both our genetics and life experiences. This chapter dives deep into the mechanisms that shape mental and physical resilience, focusing on the role of hormones, stress responses, and behavioral conditioning. The role of cortisol in toughness. Cortisol, the body's main stress hormone, plays a huge role in our toughness. The thing is, we have very little control over how and when it's released. Cortisol helps prepare us for stress, but if it stays high for too long, it can harm us. What's interesting is that we're often unaware of our own stress levels. Cortisol operates mainly outside of our conscious awareness, creating a disconnect between what we know and what our body's doing. This shows how deeply ingrained and automatic our stress responses can be. Embracing novelty as a challenge. Mentally tough individuals look at novelty as an opportunity rather than a threat. They approach new situations with a mindset of challenge and growth. This ability to reframe novel experiences is key to developing resilience. However, chronic stress can mess with this mindset, leading to learned helplessness and physical illness. Studies on animals, like rats, show that short-term stress, followed by recovery, can actually build resilience. This means experiencing controlled stress can make us tougher in the long run. The role of hormonal regulation in performance. Experienced traders and athletes have developed the ability to manage their hormonal responses, especially testosterone and cortisol. They can tap into these hormones when needed and return them to normal when the immediate stress passes. This ability is crucial for maintaining long-term performance without burning out. World-class athletes, for example, have the physiological advantage of pushing through tough physical and mental challenges without exhausting themselves. Offensive versus defensive responses to novelty. Our response to novelty can be broken down into two categories. Offensive response. This is when we see new situations as challenges, making us feel energized and ready to engage. We often experience this as flow, where we're deeply focused and performing at our best. Defensive response. On the other hand, when we perceive novelty as a threat, we feel stress, fear, and hesitation. This response drains our energy and makes it harder to adapt, leading us to avoid new situations. Whether we adopt an offensive or defensive mindset can depend partly on our genetics, but also on our life experiences. Early exposure to stress and developmental influences help shape how resilient we become. Exercise as a pathway to toughness. One of the best ways to build toughness is through exercise. Exercise is essentially a controlled form of stress that helps strengthen our body's ability to handle future challenges. The benefits of physical activity go beyond just physical health. Exercise boosts mental resilience, improves our mood, and helps regulate stress hormones. By regularly exercising, we train our body and mind to handle stress more effectively, making it a key part of building resilience. A new model of fatigue. Fatigue is usually seen as the body and brain needing rest. However, a new way of thinking about fatigue is that it's a signal that the return from an activity is no longer worth its effort. Fatigue isn't just about being physically tired, it's also about motivation. So, the cure for fatigue isn't just rest, it's a fresh source of motivation. And guess what? Novelty can provide that boost. New and exciting activities can reset our motivation, giving us the energy we need to push through fatigue. Managing stress through familiarity. While novelty is great for motivation, it's not always the best thing during high-stress times. If we're already stressed, adding new challenges or surprises can just make things worse. In those moments, familiarity becomes key. Sticking to routines and familiar environments helps reduce cognitive load, which can be a lifesaver during times of stress. Keeping things predictable helps conserve mental energy for what really matters. From molecule to market, understanding market crises and the role of human biology. Financial markets today are more volatile than ever. But have you ever wondered why market crises are becoming more frequent? It's a combination of many factors. Financial deregulation, lower margin requirements, high leverage, the rise of emerging global markets, and a shift from long-term thinking to short-term speculation. Each of these plays a role in amplifying instability, making financial markets more prone to extreme highs and lows. Let's break it down. The role of deregulation and leverage. One of the major causes of market crises is financial deregulation. Over recent decades, governments have relaxed restrictions on financial institutions. This has led to more complex trading strategies, increased risk-taking, and reduced oversight. In turn, traders and institutions have started taking on huge amounts of leverage, borrowing money to amplify profits. While this can lead to big gains, it also magnifies losses. When markets take a downturn, highly leveraged positions can quickly collapse, triggering failures across the entire financial system. On top of that, low margin requirements, where traders can control big positions with a small initial investment, encourage risky behavior. This means that even small market fluctuations can result in huge profits or devastating losses, contributing to increased volatility. Emerging markets and short-term thinking. Next, we have emerging markets. As new global markets open up, especially in economies like China, there's an exciting opportunity for growth and diversification. But these markets bring uncertainty too. Investors often don't have reliable data, which leads to speculation based on emotion rather than facts. Then there's the shift in how we invest. Investors have moved from long-term stability to short-term profit maximization. With the rise of algorithmic trading and high-frequency strategies, markets now often follow short-term price changes instead of focusing on the fundamentals. This shift has only made markets more volatile, making them more prone to sudden crashes. Keynes and the psychology of markets. John Maynard Keynes, the famous economist, introduced the idea of animal spirits. Basically, he argued that market behavior isn't always rational. It's influenced by human psychology, like emotions and herd mentality. In fact, Keynes believed that confidence, optimism, and fear shape market trends. This perspective is still relevant today, as we see markets driven by irrational exuberance. People get excited, driving prices up, but when confidence wanes, the bubble bursts. Addressing irrational exuberance, the role of education and information. So, how do we address these market swings caused by irrational exuberance? One idea is improving financial education. If investors understood economic fundamentals and risk management better, they might not fall into speculative bubbles. But here's the thing. Even educated investors can make emotional decisions. History has shown that knowledge alone doesn't necessarily prevent market crashes. After all, human behavior is influenced by biases, emotions, and social factors, making markets unpredictable. Reducing testosterone-driven market volatility. Here's something interesting. Testosterone plays a role in financial decision-making. Studies have shown that high levels of testosterone can lead to overconfidence and risky behavior, which can create market bubbles. When traders win, their testosterone levels rise, making them take bigger risks. This cycle pushes markets to irrational highs, only to collapse when reality sets in. A possible solution? Increase diversity in trading environments. Research shows that women and older men tend to approach trading differently than young men. Women, for example, are less likely to trade impulsively, often opting for long-term strategies. Their approach could help stabilize markets by reducing volatility. The impact of gender on investment performance. When we look at performance data, we see that women might have an edge in certain investment roles. One study found that single women investors outperformed single men by 1.44% annually. Why? Women tend to trade less often, avoiding impulsive decisions and unnecessary transaction costs. This more cautious approach often leads to steadier long-term gains. Women also make up a significant portion of asset managers, where longer investment horizons allow for careful analysis. Unlike the high-speed trading environment, asset management benefits from patience and strategic thinking, qualities that women investors tend to excel at. The importance of self-awareness in trading. Now, let's talk about self-awareness in trading. There's an ancient Greek saying, "Know thyself." And in the context of financial markets, it's incredibly relevant. Understanding your own psychological and biochemical tendencies can help you make smarter decisions and avoid emotional investing. Recognizing how hormones like testosterone and cortisol influence your behavior, being aware of cognitive biases, and learning to manage impulsive reactions can help stabilize market behavior. It's not just about regulations and economic policies, it's also about understanding and managing the biological forces that influence our choices. And that wraps up our deep dive into the hour between dog and wolf. This book gives us a completely new perspective on financial markets by showing how our own biology, hormones, stress, and emotions plays a massive role in risk-taking and decision-making. John Coates brilliantly connects neuroscience with trading, helping us understand why markets can be so irrational and how traders' bodies react just like athletes under pressure. If you found this breakdown insightful, don't forget to like, share, and subscribe to stay updated with more book summaries on trading, finance, and human behavior. Your support helps bring more valuable content like this. Let me know in the comments what you think about the book, and if you have any suggestions for the next one, drop them below. See you in the next video.